Doing due diligence on deals is a laundry list of due diligence items on syndications and private placements. This is, of course, not any tax legal advice here, but just a little bit context on myself. I own and lead a syndicating group, the Huido Pipeline Club. We have over 105 members in our paid mastermind group, well over 900 investors that have invested with us in the past. We've acquired $2.1 billion in real estate, which I think is an important number. That's probably tip number one right there. I would be wary of working with anybody under $1 billion of assets under ownership, especially under 500 million. And we've raised over $200 million of equity within our group, 10,000 rental units, 65 plus projects. And I guess more importantly, $45 million of distributions back to our passive investors. A little quick background on my story. I call this a linear path where we're all taught to go to school, study hard. Both my parents, doctorates and master's degree. And that was what I was blindly led to do. Maybe because I was good at math and science when I was a kid. I went down the engineering track, got a couple of engineering degrees, and started to work for the man in 2007 as a construction supervisor for BNSF Railway. Eventually headed more into the office to do more design permitting and other construction projects from there. The second half of my short stint of a decade working as an engineer, I was a city engineer, then I was an airfield engineer, kind of moving from private to public sector for quality of life. What I was really more passionate about was my real estate investing on the side. But yes, it can start as a side gig and then move off to something more. A couple years after college, I saved up to buy a Class A rental in Seattle, Washington. And that was where I got this taste of cash flow and alternative investments. And I realized the huge difference between alternative investing and the 401k, traditional investments, buying a house to live in and paying down debt versus I think what a lot of us have come to realize is a better path forward. So I went and bought more rental properties. Eventually, I came to a point in 2015 when I had 11 of these turnkey single-family home rentals that I think a lot of investors get to. Mines were in Birmingham, Atlanta, Indianapolis. And I realized it wasn't quite scalable after that point, especially for accredited investors to expand their portfolio past $1 million, $2 million net worth. And so that's the group that I work with today. People who have gone in several rental properties and moved beyond that starter level path. Personally, I started to join a lot of masterminds, started investing in apartments. And from a numbers perspective, this is how my income and expenses looked in my early 20s. For those of you guys who would like this diagram, you can go build your own. It's called a Sankey diagram. You can just Google it. But it's a great way to communicate this to your spouse. I know a lot of our investors, it's primarily, if you're listening on this webinar, you're probably the lead in the financial portion of your family for this stuff. But it's really hard to tell the story of where money is coming from and where it's going. And with this diagram, you can see the changes that I went through my first several years of buying all these little rental properties, increasing the amount of income and the savings. Eventually, it came to a point where I was an accredited investor and had this realization that rental properties just weren't going to get me there. This was cool when I was in my 20s and could just run around as a bachelor and do whatever I wanted. But when you start to have families and you start to have a second person you have to run decisions by, things get a little bit more difficult. Started to get involved in more syndications and private placements, started to add that to the portfolio. Eventually quit my engineering job full-time 2018 and went full-time into real estate syndication myself. Eventually, this was I would say a few years ago. What I attempted to do here was put all my individual deals on the chart here, where I graphed it arbitrarily from Class A to Class C, from heavy reposition down to yield plays. As true engineer form, you try to create each circle in somewhat proportionate to the amount of the holdings there. But I've just lost track of it all. But that's, I think, the vision for investors is to get involved in dozens and dozens of deals. So you're diversified over 4 to 6 year time horizon. So in case a 2022, 2023 correction happens, the majority of the fleet is still around. We work with people and help educate and create the community for people to incubate and get started in this world, because that was the world that I came through, even after owning rental properties for a long time. I started to invest in real estate syndications probably around 2015 and 16 after I was doing a lot of rental properties. I knew about rental properties looking at due diligence on that. But when you're looking at syndication deals, unfortunately, it's very much like looking at a black box from the outside, right? You don't know. A lot of times you're not going to go visit and walk units and stuff like that, especially as a passive investor. So what I put together here are some things to spot check from the outside, at least things to now be in comparing different deals together. And there's different ways you can deploy either with a cash flow focus here on the left side or equity growth focus on the right side, where you're just trying to go after deals that like bigger pops. Because what we've seen when taxes triple or quadruple in some areas and insurance triples too, and interest rates go up and your debt service goes up, what you thought you had cash flow disappears. So at the end of the day, it's all a equity appreciation game anyway. What's my focus here? Is it more equity growth or is it more cash flow growth? Or is it both? It's the answer is somewhere in the middle for everybody here. Some people have different thoughts on how they do this. Some of the younger guys are like, oh, let me just go for it, right? Then I can go for more cash flow focus later on. But again, we're not talking about one deal. We're not talking about 5 deals. We're talking about 12, 24, 36 deals. But I think this does give a high level until at least you're aware of things, because that's the whole thing is in the beginning, you don't know what you don't know. And we were all there at one time. And then you start to become aware of these types of things. Now you know where to look. You know what to ask ChatGPT, for example. But if you don't know what the questions are because you're not aware, it's really hard to move forward. And what I tell a lot of people going through our e-course, or you read a lot of books, we also have a podcast, is even if you're aware of it, what really helps is getting around a community of other like-minded, purely passive accredited investors and start to jive with this type of stuff. But for now, we're in prerequisite stage, right? This is the intro class. I've got 8 different things to look at when you look at a deal. First thing here, when you're first getting a deal from an operator or sponsor, general partner, a lot of these words are sort of interchangeable. The first thing is, what kind of a deal is this? Is this a debt or equity deal? So a debt deal is basically, I'm going to lend this person money and get a preferred rate of return or interest rate back on it. And it's very similar to a hard money loan. Unfortunately, it's also ordinary income. But if you're investing through your self-directed IRA or solo 401k, you're insulated from that. The other side of the equation is an equity deal, where it is a little bit more of a risk, but you do get the upside. I was looking at this other deal lately. It was a movie deal. So you invest money, not quite with Marvel movies, because you can't get involved in those types of deals. Those are institutionally funded. But think shitty movies, like Lifetime movies. Like a lot of that's funded by individual investors. They can be very lucrative, some of these things, but most of them, when it's like a Lifetime movie, it's a lower risk but lower return type of investment. But the way they structured that deal for investors, it was just a straight return. So I was like, nah, I'll pass, because if I'm going to go into something I'm not comfortable with, investing in movies, even if it is known to be as a safer type of asset class within that asset class, I want the upside. So I was like, nah, I'm fine. I want common equity as opposed to debt in that circumstance. Sometimes you can invest as preferred equity, which is a hybrid between the common equity and the debt. In case things go bad, you're a little bit higher in the capital stack. So you're protected, but you don't have the upside. So before you even look at a deal, what asset class it's at, even outside of real estate, you ask yourself, is this a debt or equity deal? At least know what you're going into. The next thing is whether it's debt or equity. Is this a fund? So you have 2 types of deals primarily. A fund or a single asset LLC or identified pool of assets. A good example of a single asset LLC would be, hey, we're going to buy this 200-unit apartment complex in Dallas, Texas. The address is 123 Main Street. That's the deal. So investors are able to look at the deal. Yeah, I like this location. I like the sponsor. Yeah, I like it. That's where my money is going. Where on the other end of the spectrum, a blind pool fund, you don't know where your money is going. You're really betting on the operator, or in this case, the jockey in the horse versus the jockey analogy. Typically, funds are put out to more retail investors. And when I say retail investors, are guys under $20 million net worth. That's all of us. We're investing in these deals that it trickles down from family offices, pass on it. The big institutional professional investors pass on these types of deals. Investment bankers pass on private equity deals, and it comes to us. Maybe not quite like going to Zillow or LoopNet, but there's a pecking order, right? And this is why families work so hard to pool their money together to get to 10 million, to 20 million, to 50 million. So you can keep ascending this ladder of better deal flow. So with retail investors, which is unfortunately us, they have a lot of funds put out there. Blind pool is another word for this, where they put a lot of different deals into a fund, and it's the sales pitch is it's diversified, but you don't know what you're really investing in at the end of the day. I would say for most investors, it's probably good, right? Especially if you're not in couple dozen deals at that point. It's instant diversification. But a lot of times, I've got a fund, it's hard. You need to always be putting your money into stuff. If not, it's just sitting around doing nothing, and it drags on your fund returns at the end of the day. And a lot of times there's not as much transparency in what's happening because there's just so many deals, whether it's a house flipper fund flipping 12 deals, and this is kind of notorious where like one deal goes down and they rob Paul to pay Peter and nobody knows, and even the person running the deal doesn't even know, or a big fund that owns 15 apartment deals. Topic here, what is a Proforma? When you look at a deal, you're always going to get like a Proforma as an LP. What's in it for me? If I invest 100 grand, was it $5,000 my first year, $6,000 my second? That's from an LP's perspective. What I'm drilling into more is the Proforma in terms of what is the asset running at we call it on the deal level. So what is the income looking like? What is the expenses? And then you break down the expenses to landscaping, taxes, insurance. This is where I think a lot of more sophisticated investors who have landlord experience are like, yeah, I understand this. I may not understand how it works on a 150 unit, 400 unit level, but I have a rental property. I understand I have to pay these things, and I can somewhat fact check or say, is this being a little bit out there, or is this somewhat reasonable? When you get a pitch deck, you're going to be given this Proforma or projected returns. Nothing in this world is guaranteed. If you want a guarantee, that's what the T-bills are for, the closest thing to a zero risk type of coupon. But a Proforma, the way I see it, it's like French for toilet paper. It's not really worth much, right? You take the Proforma, but what are the assumptions, and kind of stress test some of those. But just for starting real high level here, what is the assumed vacancy rate? What are the operating expenses? And now for beginning investors in your first 1 or 2 years investing in this stuff may make no sense to you. And you're going to just have to be okay with that when you're first starting out. And this is where sometimes people will tell new investors, just bet on a good operator because you don't know anything other than that. But my whole thing as an engineer, and I don't think the numbers are that difficult. It's just people get intimidated by this type of stuff. How do you get over this barrier? You need to start learning the glossary terms, right? Like when I started to salsa dance, I don't know like all the movements. I don't know how to dance, but I'm going to learn the terms first. So these are some of the terms I think would be good to just look up on the internet and understand. You may not understand how it really works in a deal, but understand at least what these things are. Some of the big things that you look at is like vacancy rate. I like to look at deals that is assuming that it's not going to be running at more than 90% occupied. To me, 92% occupied is full. You're not going to get much more full than that. If you're running that thing at 94, 95% and up, your rents are too damn low. Bump your rents. And then you're always going to have industry standard is 2 to 3% of economic vacancy. So that means if you have an apartment building of 100 units, 3 of those people are usually not going to pay your rent. That's just normal. And that's in better properties too. That's class B and A. In class C properties, like we've had it as high as 20%. People just don't pay. But that's just how it is. And I think a lot of us, we live in this banana republic world where, especially here in Hawaii, where everything is so expensive. That's not how the majority of America lives in Alabama, Texas. But when you're looking at these deals, what are they assuming the full occupancy is running at? And then are they also assuming that they're going to have 3% of vacancy once you get to stabilization 2 to 3 years down the road? Now, if I'm saying a word that you don't understand, just stop me. There's no dumb question. unless you ask it 3 times. But I think it's like anything else, like a lot, especially like a lot of the estate planning stuff. Until you hear this, then it doesn't get sunk in your head. But let's like dive into what these words mean. So when you see it on a deck 4 or 5 times, you're like, okay, now I see comparisons. I'm seeing trends here, what people are running these assets at. Like operating expenses. Some investors, it's like does everybody know the 50% rule here on rental properties? You make $1,000 in rent. Normally 50% of it, $500 goes to expenses, taxes, insurance. So I think that's a good general rule. If you don't know any of this stuff, just apply that. It's a good starting point. Most investors don't dig into each of the line items, vacancy, or like landscaping. But property taxes is a big one because a lot of the properties we'll invest in are places where it's getting better. But there's a huge train slack in terms of property taxes, like Texas have doubled, tripled because the property values have come up so much over the last 5 to 10 years, and it just takes a while for that train slack to hit. So one of the general rule of thumbs in terms of underwriting is you want to assume that the taxes are going to go up 50%. So that might be a good thing to spot check or a good question to ask. Hey, what are the property taxes on it now? What are you assuming is going to go up in year 1, year 2? That would be a good question to ask. And if you guys have questions, ask it. I'll tell you if it's a bad question, and we'll talk about why. Because sometimes there's bad questions, right? Sometimes people look at things myopically and they lose sight of the bigger whole of the picture here. Another general rule of thumb is expenses, which include all those line items, $4,000 to $5,000 per unit per year is a good general rule of thumb that you run Class B assets at these days. Your 1,000 square feet apartments. Yeah. Which now have tripled. So you might want to see that coming up with a pace of inflation. So 5,000 per unit. And this is, yeah, so Proforma means nothing. That's French for toilet paper, right? So that's what we do when we analyze this. And this doesn't get shared with passive investors. The trailing 12 financials get pulled into the spreadsheet and then the last 2 years too. So we know what this thing is buying at. And this is why we like these asset class, right? Because you see what it's running at. So if I'm going to buy your business, I want to see your profit and loss statement. I want to see your runway rate. I've started to invest in angel deals, and it's dumb because it's like there's no income and it's not there yet, no run rate, right? But there might never be, most likely not. Like 90% of the time, you're just burning up your money doing that type of stuff. But your returns can be amazing. But with this stuff, you have the run rate that you can see the last 12 months where you're like, all right, this is where it was. And then a lot of the things that we're doing is real basic. You're just cosmetic renovations to bump the rents. All right, let me go look at my income. If I bump my rents up $50, and there you can be like, all right, here's the new income and here's the new net operating income derived off of that. But we and everybody else has to put a pro forma together to derive what the returns are. But again, that's where it's your guys' job to understand, all right, are you being conservative with all these things here? Which most people don't understand. But I think it's good to acknowledge it, that it's here, because it's classic. Like most investors are like, oh, I saw the numbers. It looked pretty good. What numbers did you look at? The one that said for 100 grand, this is what you get? That's not the numbers. The numbers is the pro forma in terms of what the P&L is. Of course, we do have a buy and hold analyzer for single family homes that you guys can reach out to us and get for free. And you can see how these numbers work on a more smaller deal, like a small rental property. And that can also help further the education process too. What we find today is, I would say half of our investors have never owned rental properties, which is fine. But the other half who owned rental properties before have a good working knowledge on how rental properties work. And they can really use that experience to extrapolate out to a 400-unit apartment complex. But as far as like asset class, we're going to be looking at more of a manufacturing deal. It just highlights different asset classes out there, right? Real estate, that's the common thread here, right? We all like real estate, but real estate, you need good interest rates. And what I realized from higher net worth investors, they have things other than real estate. They own businesses. If not, they're maybe not the operator of their own business, but they own portions of private equity and other companies. But sticking to multifamily here, which is what we specialize, these are some of the industry terms to understand what you're investing in. A garden style suburban is pretty typical. I think what we'll see within our ecosystem here. You could also have high rises, mid rises, and mixed use. Typically, the high rises are class A or institutionally traded, which is why you'll see in people that trade in under $50, $100 million assets, the garden, the suburban type of investments. But this also fits in the narrative of you may not want to be investing in the core business area because your numbers aren't going to be as strong there as in the suburbs. Here's another ways of saying what I'm going to be showing in the next coming slides, but this is taken straight from institutional investment portfolio management. To me, what I try to do is take these types of esoteric terms and bring it down to like regular people like us. They'll describe investments or locations or assets as class B and C or core plus value add in terms of what the business plan is. But I'm going to explain it in a little bit more down to earth. When you talk about a deal, all right, what kind of property are we working with here? So property classes. So we rank these in terms of A, B, and C, and D. There's not really any type of numerical designation for each of these. But for the most part, like how old the property is pretty much determines if it's class A, B, C, etc. So your class A is going to be your new high-end type of assets. I would say today built 1990s and later. Class B is your older stuff. These are like 1980s, 1990s assets. Class C is 1950s to 1980s. So the older it gets, the lower the grade gets. At some point, once the asset is 50 years old in the commercial world, these things get bulldozed and made new. One great example of this, of course, a different asset class of hotel investments in Las Vegas, Circus. What a crappy hotel. Sorry if that's where you had a lot of good fun memories as a kid, but it's crappy, right? So that would be a good example of a class C type of hotel. At some point in the next decade or two, or who knows, maybe they already have plans of it. They're either going to renovate it or they're going to bulldoze the thing and build it brand new. But that's an example of what we do on the apartment side, right? We take an older asset and revamp it new, but we also do new developments too. There was a question that somebody submitted, oh, what's good now? These days, right now, there's a lot of extra supply hitting the market in a lot of markets because prior to 2023, when the interest rates started to go up, everybody and their mother was taking advantage of this free money. So everybody built stuff. So like how people are born in 9 months, developments are born in 2 to 3 years. So a lot of that tail end of that wave is hitting right now, which is nice for people in the market because that's going to go away after next year. And there's going to be a big lull right there. But right now, your new stuff, which is your class A stuff, is being added on the market. And the losers are this value add and this lower end stuff, the class B and C stuff. Imagine like your new stuff goes on the market at $2,500 per month, right? Your slightly older stuff that would have gone for $1,800 to $2,200 a month rent, it's being competed because put yourself in the shoes of a young millennial. I'm just going to go for the really pretty stuff that has like a bar in the lobby for $2,500. I'm just going to stretch and go from $2,200 and pay a little bit more because I'm really bad with my money anyway, and that's what young people do. Right now, you're having a crunch on that more value stuff temporarily. There's this train slack effect. So right now, if we're going to do value add projects, it's going to be more of this core plus stuff. So this is going to be like stronger areas, less tertiary markets. So stronger areas are like the big secondary markets. We don't invest in California, Hawaii for obvious reasons, but like your Dallases, your bigger metropolitan areas, less tertiary markets like those, like Wichita Falls and those types of markets. And then also that also means your nicer stuff. So class A, but built 2020. So not brand spanking new, but not 1980s class B. So that's just, maybe that'll be the trend for the next few years. And then it'll change, I'm sure, as things change all the time. On the second thing is the neighborhood class. So I think this is a lot more important what the property class is. because you don't really have too much control over the location and neighborhood. And it's also determined on a class A, B, C criteria. I think most of the people living here tend to live in class A neighborhoods. Why? We got money, right? We got some disposable income. We like to live in nice areas. Class B it's an okay part of town. You probably don't want to be there at nighttime. Class C you probably don't want to be there during the daytime or the nighttime. Class D is just bad area. And then class F or war zone is pretty much the same thing. This is a lot harder to nail down. Never listen to a broker, never listen to a syndicator. They're always going to sandbag you and lower the grade on one level. But I think this is why we tell investors, well, come with us on a field trip, walk a couple properties, and then we'll give you some data points. And you'll have some working knowledge of, yeah, that time I went with you to Fort Worth. We walked that class B minus location. Wasn't too bad, but now I know what a B minus is in the future. This is what you generally want to be looking for. These are the location classes. Ideally, you want to be in this red circle right here. You never want to be in the best area, because in the best areas, you're always going to be paying a premium, right? And we're investors. We're not necessarily living in these investments, but we want to find the best value, right? As far as the property class now, you're okay taking a class C property because you're going to do some value add to bump it up. And part of that value add could be as little as $5,000, $10,000 of renovations per unit. So that's known as lipstick on a pig, light value add, 5 to 10 grand per unit. Everybody should be writing that down. That is just going to minorly get you from a C plus to a B minus type of assets. This is where there's a bit of a cat and mouse game between syndicators and investors that like, oh, we're going to do all this rehab and it's going to be turning it into a class B to class A property. I don't know. That ain't going to happen in my opinion. That's like believing the Easter Bunny is real. Maybe if you're doing like 20, 30 grand per unit, but at some point it makes more sense to just build the thing from scratch. The reason why we like this lower middle class workforce housing in the class B and the C sector is because in a recession, what happens? The A's come back to the B's, come back to the C's, and the majority of the population is living in class C housing out there. I like this narrative because the lower middle class is growing. It's that middle class is shrinking. I think that's a lot of us here that's holding on to that cliff. And that's why we're trying to invest, so we don't become like the shrinking middle class. But generally speaking out there, the majority of the Bell population curve is in that C class area. And that's why we like to invest in that area. In 2020, we started to build brand new developments it's considered class A, but it's not luxury at all. It's very much for lower middle class folks, or for some of us sending our kids to college for the first time. You might put your kid in something like that, like a decent newer build, $1,400, $1,600 a month rent. Unless you spoil your kids and send them to the Amelie where there's like a bar in the lobby and you're into that type of stuff. But I think that's the type of still class A workforce housing type of apartments that we'll build from scratch. But this is some of the stuff that we've done in the past where this was a class C property. You see the yellow gross appliances. We changed those out and just repaint and change out the hardware on the faucet, and the cabinets are repainted. And something like this might just cost $3 grand, $5 grand to do, and then you bump the rents up couple $100 across the board. Just some fundamentals before we get diving more in. We tend to buy in red states because of landlord-friendly laws. We try to stay away from short-term rental properties because I see it as discretionary spending in a recession. People don't go and do as much vacations. When I first started to invest, my first 11 rental properties, I did this buy, hope, and pray model where I just bought something that cash flowed and hoped that it would go up. Where when you get involved in syndications and private placements, there's typically a value add type of business plan. Spending 10 grand per unit to bump the rents up $150, right? So you're taking fate in your own hands there. Here's what we've done in the past. We always very focus of the project is to rehab units and push those average in-place rents over time. This one was actually the one that we had 80% collections on. So that was why we opted to sell this one as soon as possible. It's a scary place to be. I didn't want to be there. But as far as you're sizing up a deal, you're looking at the pro forma. The tangibles are like, all right, do I like the location? Right? Am I a believer in this location? In most cases, when you're looking at a pitch deck and you're looking at like the 6, 7 pages of Dallas, Texas, most times I throw that thing away. This is a waste of time. It's just filler to me. To me, you as an investor should already know what are like the more favorable places that everybody's investing at that point. But that's the big one, investing in a better location. The next thing is the year built, because the year built will determine if it's a core plus or where it falls in the pecking order of asset classes out there. As far as this stuff goes, pretty similar most markets, square footage. These are just, again, like the statistics on the assets. When you're looking at a deal, these are some of the tangibles that you want to be looking at: the location, year built, square footage. I would also look at the rent per square footage, like a personal thing. I just want to know where it's at. Most properties today, Class C to Class B, are in about $1 to $1.50 a square foot for rent. Some investors, they like individual HVAC units because then it's easier to predict when those things are going to go out, as opposed to that chiller broke, right? And it's, damn it, they cost like hundreds of thousands of dollars, and it's hard to model when that thing breaks. Which more modern, built 1980s and after, they tend to have individual HVACs. Maybe, I don't know for that reason. I don't know why, but it is, where the older properties have those awful chiller systems that just break at the wrong time. So that kind of tells you what kind of asset it is right off the bat. But as you can see, that was just a personal thing of mine, right? You know, I think a lot of times, like, this is where you put a lot of trust in your deal sponsor in doing the due diligence on what are the deferred maintenance items to be fixed. The big ones are the roof, the plumbing, the electrical. A lot of it is like electrical, for example, it needs to be copper, can't be aluminum. That's like the old way. The bank will mandate that the electrical system be more modern. Right? If not, you don't get a loan. You don't really got to worry about that type of stuff. And this is what's nice when you have a bank involved. They're also doing a lot more heavier institutional due diligence on this, and they don't give a loan on something that doesn't fly. But the roof is another big item. You see a lot of deal sponsors doing this stupid thing where they take a ladder and they go up there and they take pretty pictures like they're on the roof, but they don't know what they're looking at. When we do diligence, we don't know what we're looking at. We get a professional third-party inspection company to itemize everything. Or like when you guys do an inspection on your guys' houses when you buy a new something, but like way more in detail and actually hold some weight. They give us like a full due diligence report, and they also give us estimates on pricing and contractors from there too. Some people say it's like you're just like outsourcing that whole thing out. So yeah, they're the experts. And this is what the institutions do too. Like, you as an investor are going to build your own nuances and learn your own way. But this is where you need to mix it up with other purely passive investors. And what I found over time is like you develop really good relationships with other people and you get different viewpoints. The other thing, sometimes it's nice to see the units upgraded already and see that the rents have already been bumped. We sent our team out to Georgia the other week to go look at a deal. Specifically, we wanted to see the 6 units that were freshly renovated and were they hitting the pro forma rents. That's verification of the business plan. But other things to know, is it Section 8 or is it just straight pay with the rents? These other types of nuances that I think for now, I think just good to be aware of. But as you can imagine, there is hundreds of questions you could ask. And we actually do have in my e-course like a full 100 question list and a full due diligence checklist. But we tell everybody, hey, just use this as a guideline. And you never want to be the person who asks the sponsor 10 questions, because you're already going to be identified as a real pain and inexperienced investor at that point. Fundamentals, again, this is a big term, CapEx, capital expenditures. Like, what's the business plan here? Luckily, in real estate, it's pretty basic, right? We know that there is a customer out there for a box to live in, but are they changing out the flooring? Are they putting new washers and dryers into all the units? This is a big thing to vet. The next thing, and now we're getting into some of these terms where what to look for as an investor, as gotchas. There will be vacancy and there will be turnover. So to see your operator perform out a financial where they're assuming that they're going to be 95% occupied and everybody's paying, is not a realistic rosy picture. So these are the things that you'll see over the time, and I personally key in on, right? Because it speaks to the level of conservativeness, the underwriting.
You're not going to get rich by just paying down the mortgage and waiting for appreciation to happen. You got to force appreciate the rents. Just like a business, you have to do things to make more revenue, cut expenses to improve the net operating income or beta.
But here's an example of that forced appreciation numbers work. That's what's nice about commercial real estate. It's all based off of numbers. It's not like residential real estate where it's based off comparable sales and emotion, essentially. These are very typical things you'll see in projects, like say the property management just wasn't aggressive with bumping the rents up. So that they actually get on it and they bump the rents up $45 across the board to a 100-unit apartment complex, creating $4,500 a month in extra revenue, or 54 grand a year. Now, the evaluation of commercial assets is the net operating income, which is the NOI is what we call it, which is the income minus expenses. So in this case, we bumped it up by 54,000, and you divide it by the prevailing cap rate, typically between 5 to 7% these days. So at a 5 cap, you just created $1 million of value right there. Another example, say you save $40 per unit by billing back utilities to the tenants. That's 600 grand there. Some of these cases, you can rent out reserve parking at like $20 or $20 for just merely 20 spaces. That's like a $300 bump in value. So the operators, part of their business plan, maybe not only to bump rents on individual units, but to do these types of things throughout the hold. And then, of course, the age-old just rehabbing units. This is the good old-fashioned way of doing it. Examples of rehabs right here. What I like about this is it's nothing spectacular. This isn't rocket science. I always say I'm just a dumb real estate investor here. This is not venture capital. We're not trying to recreate the wheel.
In these Class C and B properties, really you're only limited to maybe building back the utilities to the tenants or doing your cosmetic upgrades so somebody pays another $150 more a month. The Class A stuff has a little bit more ability to charge them extra stuff. A lot of us haven't lived in apartments in the last 10 years, but it's crazy. Like you pay your $1,275 for rent, but then you got this add-on charge. As soon as you know you're paying $1,500. On the Proforma that you get from your syndicator, a lot of that's captured in other income. It seems really like obscure, and it can mean like vending machine revenue. It can mean maybe they're building covered parking in Texas is a big thing to prevent the hail from hitting the cars. So they might charge somebody extra $50 or $100, or they might build storage sheds. That's other income. It's a huge part of your higher A class, or even 1990 properties and bigger. It could be maybe 10 to 20% of somebody's rent. But I think for the lower end properties, the name of the game is just rehabbing units, bumping the rent. But that's how you create this incredible bump in value, by doing this over time through the slow flip method. And that's what people pay for. And if you're one of these people who really likes the whole, we're improving the community, that's what these pictures are for. Like it's improving the community, making it better. People pay more in rent.
Switching gears a little bit, deal structure. Now, what this all is held together with is a private placement memorandum.
The private placement memorandum. So I consider that like a packet, a legal document packet. So like we were talking earlier about trust, you have that thing where in case you come in incapacitated, your will, your trust, your documents, whenever you sign one of these deals as a passive investor, you should have your PPM, your subscription documents, and there includes, there's like an application, technically an application where you're saying like, hey, I'm an investor, this is how I'm qualified, I'm not some bozo, let me into the deal, please. So all this is what's known as most people just call it the PPM for short, private placement memorandum. It's usually like 100-something plus pages.
Investors pulling their money together essentially triggers securities law, SEC. So once you do that, the operator, sponsor, general partner, whatever you want to call them, they have to go through the proper SEC channels and create this big PPM document. For us, like we usually pay 20 grand, 30 grand for it, for each one of these things. But this kind of sanctions that capital is coming in one place. And to me, what it does two things. It protects passive investors, that the general partners have fiduciary responsibility to investors. And it also protects the general partner, because say a deal was projected out to get 100% return in 5 years and the return is 80%. Nothing to stop passive investors for suing for the remaining 20%, which is incredibly messed up. But hey, that's the litigious society that we live in today.
What I personally do is I just go Control F and I look up the word FEE, fee, and I just make sure that the fee structure aligns with what my understanding of the deal is. And then I also look up like how the GP-LP splits are. And then also if there's a waterfall, that's how I find it. Now, there's a whole bunch of things that I've learned throughout the years, like when things go wrong, voting rights to kick somebody out. It should be written pretty neutrally. Not always the case, but I'm not giving any legal advice here, but certainly not worth anybody paying any money to get it reviewed. It is what it is. They're structured different ways. When we go into a deal, like this last deal, had a really confusing org structure, and that's what this is, right? This is a classic one. You have the asset here. It's owned by an LLC, and then everybody's got ownership of the LLC, right? This is why you can't 1031 into this stuff, because if you're selling off your rental property, it's real estate. Here, you're buying business interest, not a like-kind exchange. You'll have some kind of structure here. I've seen it extremely confusing where you have a secondary lender, preferred equity, but to me, graphically, it really helps to understand, for me, what we're getting into. But this probably goes well beyond what passive investors will do. What we want is, when we go into a deal as a group, we like to see, all right, is there a preferred equity lender in there? And how are our terms split with them? Because the preferred equity could be a two-face. They could be predatory at the end of the day. You don't know. But unless you go through problems, you don't learn about this type of stuff. But this is stuff that you can see where the family office is. This is second nature to them. And it's, in a way, it's getting second nature to us. We know different parties involved. Sometimes it can be a good thing, right? Because if a preferred equity partner is coming in, they're the institutional pros vetting this deal too. And it's good to be alongside the same deal. Maybe in a different part of the capital stack, but the same deal, same asset. But at the end of the day, the Proforma where we're talking about earlier, we're like, what's in it for me, $100,000 investor? It goes through all these splits and fees, somebody takes into account. And that's, at the end of the day, maybe that's what my view of the world is. We're gonna get into a deal together. It's not gonna be all of our net worth. It shouldn't be. It shouldn't be more than 5-10% of your net worth. And we're gonna see if this goes well. If it doesn't, we don't have to work with each other again.
Of course, I always say the people I work with, it goes beyond this paperwork, right? It's more about working with honest people who have ethics and relationships. And that's the trouble, I think, going beyond this due diligence talk here today. It's really hard to find, when you invest in as many deals, like 20, 30 deals, and you don't have a community around you, it's going to be really hard not to step on a landmine here or there. And that's why, again, I sit at the top. Try to stick with operators above $1 billion of assets under management. And that's brings up this whole idea of the counterparty risks. I will identify two types of risks in deals. First is like the deal, right? Is this deal going to work? Is this business plan is vetted? Are they using conservative numbers? The other part of the risk is the counterparty risk. Is somebody going to steal my money? I've run into this on a handful of occasions, right? And that's why I put a lot of emphasis on the people that you work with. This is unfortunately, unless you start working with people or somebody who's invested with somebody in the past, it's really hard to determine who's legit in this industry, unfortunately. I think that just develops over time.
All these deals, they're only as good as like the people that you are working with. FTX was a good example of this that turned out to be a big Ponzi scheme. Sometimes there's like just people just stealing money, and it happens out there. That's why it's good to be plugged into a network and at least know who are the bad players out there. And if you're uncomfortable with this, then I totally get it. You could invest in more institutional firms, guys who have $4 or $5 billion of assets under ownership or better, but you're not going to get the returns from those guys. You're not going to be doubling your money in 5 years. You're going to be doubling your money in 10. For people who aren't worth $10 million yet, you got to take on some risk. But that's been my whole thing is I date around a lot and I work with a lot of people. And sometimes I get burned, especially in the beginning. But once you figure out who are the trustworthy people out there, you tend to stick it together. But that's why you have all these contracts and then you have to get lawyers involved. And so some general tips if a syndication is legit. First, you learn and you understand the numbers that we talked about earlier. You try to underwrite the deal if you can or vet some of the assumptions. You try and work with good people or stick with others. I call this proxy investing. Somebody says, hey, I got a good oil and gas deal. I'm like, let me know how it goes. But that's how I learn, right? Through you, right? Did you get your arm blown off or running to the landmine field? But if everybody collectively is doing this, gathering data points, that's a lot better than me going it on my own.
But when I first started to do this, my little secret was I would get to know the syndications attorneys and I would know who was legit in the business. Over time, you figure out who performs. I talk a lot about my first deal as a passive investor in 2012. I invested with these guys and they were just shysters and they just stole the money. I've made the mistake a few times more, but I think the more and more you grow your network, the less risk and chance you have stepping in these landmines. But I say that not to discourage people, but I think it just puts emphasis on building your network of other passive investors, and you just have to diversify over time. Let's get into back to things that you can control. Now that I've scared everybody, I want to try and empower everybody with some things you can actually look at. So again, you're looking at a deal and you're like, all right, what's the rent projections that the operator is showing me here? Looks like they're saying that the rents are going to go up 5% every year. Heroes, even in 2000, when things were going pretty well, Dallas was at 4%. So this is called the rent escalator in the underwriting sheet or the financial due diligence part. Normally, what you want to see is anywhere from 2 to 3% rent escalators per year, and which is mainly to account for inflation. But anything higher than that, I would scratch your head a little bit. Not saying it's a deal killer, but I'm just making people aware of this type of stuff. A lot of times the operator sponsor will not openly come out and tell you this, of course. Why? Because they're trying to sell you the deal. But you can probably tease it out if you're able to interpolate these numbers on the grant potential income line up here. You can tease it out what it is. If you want to interpolate this, just add ChatGPT, put this number in and put this number in and say interpolate this. But for those of you who's a millennial or older, you actually know how to interpolate this, which is you take this number minus this one, and you take that number divided by this and you get a percentage. And you're trying to see if it's, again, between 2 to 3%. Anything higher might be a bit of a head scratcher right there. All right. If anybody's sleeping right now, this is the most important thing ever. This is called the reversion cap rate. I call this cap rate gate. It's one little cell on the spreadsheet, but if you really wanted to fudge your numbers, you just change this one cell on the spreadsheet. And what this is, it's basically saying like, all right, we think that we're going to sell this deal 3 years, 5 years from now in this type of market, right? This is what the reversion cap rate will be, or the exit cap rate will be at the time and when we sell.
Detach this, like people talk about, oh, what's the cap rate of the building, which could be 4%, 5%, 6%. This is nothing really to do with that. This is just what is the assets for this particular asset class in this market selling for at this time or in the future, which is your reversion cap rate, also known as exit cap rate. So if you're buying a Class B, let me use something I know. Phoenix Class B, I think at one time it was selling for a 5.5, 5 cap rate, low fives. If you assume that the market you sell for in the future is going to be at the same or lower, you're assuming that the market's going to get stronger, which is not very good in terms of being conservative. What you want to be doing is increasing that prevailing cap rate a little bit higher, 0.5% maybe. So this is a funny meme, right? You're buying it at a 4 cap rate, and then if the market is 5%, you're effed. And that's why the Proforma, we were talking about the Proforma earlier, that's all this stuff. Oh, it should be this in 5 years, right?
The thing is, nobody knows what the reversion cap rate will be come, 2029, right? A good rule of thumb is to increase the reversion cap rate to assume that you're selling it into a softer market. Counterintuitive, but on the next slide, when we play around with the numbers, you'll see. But The property value is the net operating income divided by the cap rate. If the market gets softer, it might trade at a 6.5 cap as opposed to a 6.25 cap. As this meme says, if you're buying something at a 4% cap rate and the market corrects at a 5%, you're screwed if you didn't account for it in your underwriting. More times than not, and this is just part of the game, folks. You have to understand this. It's like you go to a used car lot, especially, and the guy's like, all right, it's $15,000. And you just laugh because there's room for negotiation. Just like an operator puts out a deal at 95% return in 5 years. All right, what numbers did you kind of mess around to get to that number? And this is, again, the biggest one here. But here's an example, and you can see how much it fudges the numbers. Say today we bought this asset at a 5.25 prevailing cap rate. And this has nothing to do with what the asset is running at. That's a totally different topic that confuses a lot of people. That's also called the cap rate of the asset. This is just the prevailing cap rate of the asset and what they're selling at. So say you bought something at a 5.25, the market corrects and it's 6.25 tomorrow. If you assume that if you were a good Boy Scout, which nobody does this these days, and assume that the cap rate increased 6.25 and your return was 100% return in 5 years. But if you would assume you only were a little bit conservative and it was 0.25%, then your projected return that you showed investors was 144. But then you were screwed because you didn't account for that. So this probably reversed the other way. I think I'm kind of explaining this a little bit confusing, but basically you see the spread in the numbers, like 40 something percent by underwriting it one way versus the other. And this is why what's on that PDF, it means nothing at the end of the day. This is where we try and teach investors like, hey, these are some basic stuff to spot check so you don't get hit by this bus right here.
That's probably the most important thing. If you're super lazy, that's all you need to know. That's like me and soccer. I don't know anything about soccer, but if something happens, I just say offsides, right? This is the same thing. If you want to look cool and you want to catch 80% of the bad deals not to invest in, it's this right here.
Moving on to this is sensitivity analysis. So you can see if the exit cap rates here change, you can see how these numbers really start to change here. Again, if you use a really aggressive reversion cap rate, like the projections can move 40% one way or the other.
Every time you fudge the numbers a quarter of a point to the wrong way, you lose like 10 to 20% in terms of returns. So this is like where it really frustrates me because people will be like, oh, this deal is only 85% return in 5 years. So yeah, because we used the right numbers, or we tried to. But the other guy, they're comparing the 114% return deal is using BS reversion cap rates. And in reality, if you normalize it, it'd be a lot less projected returns. And that's why the Proforma means nothing. What I'm saying is everybody is dicking around with these numbers. Everybody's doing it. We're doing it. These are all guesses what the reversion cap rate is going to be in the future. So what you have to do is take that with a grain of salt. And what is the reversion cap rate in relation to prevailing cap rate today? All right, that's not conservative enough. Let me just downgrade your projected returns off of that. At least let me compare apples to apples. This is where they have to give you accurate numbers, but this is a cat and mouse game because I can give you the prevailing cap rate and the reversion cap rate, but there might be other things in the underwriting that might be changing some of the numbers around. So you have to be very careful how you ask your questions. So what I would ask is, what did you guys assume the exit cap rate or reversion cap rate to be? And then this is where, yeah, you could probably, if you're lazy, you could ask them, what is the prevailing cap rate for this class? But it's always going to be within a range, and they're always going to be giving the lower end or the higher end that helps them. So this is where it's nice to have a group up together and be like, oh, what is class B in West Fort Worth? What's the prevailing cap rate for that? And then add on a 0.5% on top of that. And that's a good reversion cap rate to use.
Some typical lending terms. Now, there's a little red there because there's definitely blood in the streets on this, and that's the important part. But here, The crossed out portion is if when I gave this presentation 3-4 years ago, what people were getting. The new one is today, so a little bit higher interest rates. The big one is the loan to values are a lot lower. And this is why I think you're not getting as many deals done today. This is why we stopped. Our last transaction was June of 2022. We haven't been very active because I can't make deals work when I have to bring 20% more to the table because the loan to values that banks are given is a lot lower. But the other thing to look at as an investor, if none of this makes any sense to you, is just to be aware of the term length. So this is different from the amortization. Amortization is typically the same on all deals, 25, 30 years, like your home mortgage. Commercial real estate, the transactions are a lot quicker. The loan terms are a lot shorter. You can't get away from this. Anywhere from 1 to a 15-year term is normal. So anything less than 5-year term might be a bit of a head scratcher, and that may not be for you as an investor. So we've seen this. And if you bought a property in 2021 at the peak of the market and the market corrected 30%, which it did, which is why it's such a great time to buy new assets at this point. But if you're in those 2021 vintage deals, you're screwed because now your $100 million asset is only worth 70 and your loan is due, right? You don't have enough runway to time you to get out of that trough in the market. So that's why we put the designation there, 5 years or less. If you had 5 years or more, you could probably value add the asset, get out of it, and or the market corrects back up to get you back to par level. But anything less than 5 years is something to be aware of.
This is the big thing that caught everybody these last couple of years. In terms of lending, it's not the interest rate. Everybody focuses on interest rate. When you are doing value add, interest rate really doesn't mean too much. Like, to use an extreme example, when you're flipping a house, you don't care what you're paying for your interest rate. You're going to flip the house, value add it, and make a boatload of money if you can do it in a decent amount of time. So same thing here. The interest rate doesn't really matter. What's going to kill you is this thing right here, the loan term. So in residential real estate, everything is 30-year term, but in commercial real estate, everything is on a sped up timeline. Loans are anywhere from 1 year to 15 years. The longer the term, the more expensive it is. So a lot of the projects that you'll see are value add projects that are supposed to take less than 5 years. So the right tool for the job is a bridge note that is 1 to 3 years in length. But if you want to be conservative, you try and go for 5. In the beginning, we would do a lot of 8 to 12 year notes. And I still think that's overkill. But that takes out of the equation of, oh shit, interest rates went up 40-year high, quickest time in history. And then now our loan is due. Our timer is up. Even though you've done a good job with the value add, your timer's up. So I would say that's written in blood. I would say that is the thing to be on the lookout. No eyes wide open going in. Now, I'm not saying if it's 1 to 3 year loan terms, not saying it's a bad deal, right? That's how you make a killing. That's how you double your money in 2 or 3 years and you look like a genius, but you're somewhat exposed too in that.
But other than that, like, all right, I'm just a passive investor. I don't have access to CoStar or Yardi, which is what we have access to and what we use to vet new deals as a general partner, or if we're going to invest in a deal as a fund-to-fund manager, we have access to CoStar and Yardi. But the problem is it's like $10,000 to $30,000 based on how many subscriptions you have. But these are great data houses. Of course, you have to take it with a grain of salt, but this gives what people's debt service coverage ratio is month to month on people's properties. And I can see what operators, what deals they have and how it's running and what their rents are.
We do a lot of spying on people and seeing what properties they own, because you can hyperlink to whoever owns this and what's in their portfolio. And then you can also see what their properties are operating at, what their debt service coverage ratios are. It's not the most accurate, but I mean, it's pretty amazing that they have all this information.
But as a passive investor, you're not going to have access to this type of information. So the next best thing for free best sources is City Data, Neighborhood Scout. These are a little bit of a composites. If you want to dig into raw data, that's where you look at crime maps, median household income, etc. that I've pulled here. And then, yeah, other things to look out for when you're doing due diligence on a geographic area is the population growth. Here are some general rules on that. We have some different rules for cities and more for neighborhoods here. But I just wanted to really highlight as we close out here some of the mistakes. Number one, I think LPs focus on the LP split way too much, or the preferred rate of return. These are the waterfall structures. And we do these retreats in Hawaii, and I always hear my guys talking about this. I'm like, guys, who cares? Vet the deal. If the deal is going to fly and it's going to work, it's going to be good. If it doesn't matter if you had 99% of the deal as an LP, right? Vet the deal. Who cares what the splits are? I know why people do this, because they don't understand the deal or all the stuff that we talked about today. They don't know reversion cap rate, and they focus in on something that they can understand and what the iceberg that's sticking on top of the ocean. But this is what, a lot of these really bad internet forums out there where it's led by passive investors and they just don't know what they're talking about. And they're talking about splits all day long. Understand what kind of an operator somebody is. There's a spectrum of operators. There's institutional operators that have done billions of deals, $5-10 billion of assets under ownership. Here, you're going to have higher fees, higher splits. So these split schemes aren't going to be very good for you, but they're going to be reliable, right? You might double your money in 10 years. But for some of my investors above a few $1 million net worth, this may be the place they want to invest, more for reliability. Also, the minimums on these guys' investments might be $500,000, $2 million, $3 million. A little bit too rich for some people's blood. Where I started as a passive investor is dumpster diving through operators on the opposite end, the fake it till you make it people, the people who give really good splits and have low fees because they're just a newbie. And it's dangerous working in that world as an investor. There's a nice little sweet spot in the middle. Like I said, several $1 billion of assets under ownership, pretty good splits, tend to be lower fees than the big guys. More importantly, good reliability. They've done this before. So I would look at it from that perspective first. Am I working with an institutional operator, or am I working with a fake it till you make it operator who's still working his IT job on the side? No, we were there at one time too, as a passive investor. Just be aware of that. And then we talked about the reversing cap rates, check comps on occupancy and economic vacancy. A normal number that you want to see for occupancy is about 92% as considered full. And then you add on top of that 3% of economic vacancy at least. So your economic vacancy is usually going to be 10, 12%. And this is where you're not going to be an underwriting specialist. That's not within the scope of a passive investor. But I think you need to understand some of these nuances here to, again, build that bridge so you can intelligently talk to other investors out there. Here's some lessons learned that we've learned in our past investing, but it's more important to build a mastermind out there. We have it within our network of investors. This is going to help you get beyond multifamily. I think a lot of people start off with multifamily and then you branch out to self-storage, ATM machines, senior living, and then get out of it like buying businesses, buying CPA firms. You get into venture capital at that point. This guy is going crazy on the buffet line. This is a bit of a mistake. I think investors, you find this world of alternative investments. Like you're going to Las Vegas buffet. You're like, give me this. I want this. I want the Chinese food. I want the pizza. And you're like gobbling up everything. What I would say is just stick with one thing. Get into at least 4 or 5 deals in multifamily first, something that you understand. A lot of us have lived in apartments or had rental properties. Start there before you start to branch out into more exotic things. And make sure you have 5, 6 other purely passive accredited investor buddies that you drink beers with and are very close with. Because this is all a game of you're getting out of this traditional investments into alternative investments. And with alternative investments, you tend to get better returns. You tend to beat alpha is the term. But I would say you need a network, and this is what we provide in our community, like to have these different conversations of how do we create our entire portfolio of all these individual deals. I would say for most people, $3 to $4 million net worth, so that you have your core capital, what's labeled here, satisfied, and then you can shoot for the moon or just retire and just relax and enjoy your life after that point. And that's what we teach is the alternative investments, the tax strategies. And a side part of that is the infinite banking here. And there's a little bit of a diagram on that. But basically, you want to do your infinite banking, accredited investor banking policy, run your investments through that. And then it doesn't move the needle as much as taxes and the deals, but it's just that third strategy that people will implement in this world. But unless like you're in a community of other high net worth people, where do you hear about this stuff? And that's been my passion. I came into this world in 2015 and I just was a sponge and like distilled all these best practices all in one place. My job continues to be like, what are the people $10 million, $50 million doing, right? And a great place to look for that is Tiger 21 is an organization for that. I think you need to have $30 million net worth to get into that or deployable assets. But straight from their data sheet right here, this is what their members have, most of which is real estate and private equity and less of what you would think of the traditional investments. Now, I don't know what they're holding, how they're holding it in cash or QRPs, but this is how their portfolio is broken down. And you can see how their portfolio is vastly different than the broke guy and the guy who in the cubicle next to you. Check out my new book. It just released this past week. It kind of distills all this information down in 200 very beefy pages. Also check out my podcast too, where podcast tends to ramble, a lot more fun there. But I think the book is pretty concise, capturing all this type of stuff. But yeah, if you guys want to book a call with me, we can go through deployment plans because there's such an order that you deploy funds out of. And it can be very complex based on where your tax situation is. But we can open up for questions.
You know this much about a topic that you started in 2015. So it's something that is obvious that you've really dedicated a fair amount of time to, and it seems like your life passion. Well done, sir.
Yeah, it changed my life, right? We find a lot of people that they might have a net worth of $1.5 million and they're paying a lot in taxes. These are the hard workers of society, right? That pay most of the taxes in reality. But some of these cases, maybe they can do real estate professional status. Their spouse can stay at home with the kids. That's just instant quality of life changer. And they net more money after taxes with extra passive losses from their investments.
So the whole point of today's talk was somewhat scare you guys a little bit and maybe use a little fear to motivate you to do that. And you might be like, all right, this is too scary. I'm not going to do this. But there's this echelon of like returns out here. When your net worth is 40, 50, 100 million, you get really good deals and you're able to cherry pick those deals. None of us are there yet. But you certainly can't grow your net worth to 8 figures and get your irrevocable trust, build a dynasty for your family unless you get past this level here. We all know this, right? Like we have to somewhat live in this world and we have to take risks over this. But with risks, you're never going to catch everything, but how can you best mitigate it on the front end by doing certain checks like a reversion cap rate? That's what I'm preaching here. If you're not cool with that, on the other hand, you don't need to be cool with that. You can just follow what other people do. That's what a lot of second generation people do. And that's what I've noticed. I think as a first generation millionaire, I think a lot of us have this idea where we're just going to do everything. We're going to learn everything. We're going to run the deal. But that's not what second generation kids do. They rely on their network. And I'm slowly realizing this. Okay, so this is the last slide. This kind of ties into what we were talking about earlier. If you're relatively younger in your 30s and 40s and you're already at that $3 million threshold, the irrevocable trust, get that thing tomorrow. If you're older and you've crested past that $5 million net worth, then get that too. I'm just throwing that out there, not giving any legal advice. But part of that has to do with this concept of core capital here. So I'll explain this. Core capital this is age on this axis. As you start to get older, you need less money, right? A lot of us here have younger kids. You guys are in this stage where you probably need $4, $5, $6 million net worth to be able to put it in cruise control and not do anything. But as you get older, especially as kids leave, they're not a nuisance anymore. You can take them off the books. Probably only need maybe $2 or $3 million or even less, right? So that's this concept right here. So the idea is that's all you need. This dark blue corresponds to this dark blue, which is lifestyle spending. So lifestyle spending is like your basic needs. It's said in different ways to mean the same thing, right? This is how much money we need to survive and some beer money on the side. But as at some point, we don't need it and it becomes more of this gray money right here, right? This is the legacy money. I think I might differ. I'm sure I'll change my mind, but I'm like, I only got one daughter and I'm like, even if I had 2 kids, I'd be like, hey, give them 1.5, 2 mil each. Anymore, you're just gonna mess them up, right? I went to private school. I know what's up. So I would probably call this light gray, but I think half of you guys might call this dark core capital, right? It's needed. But at least we're talking about these concepts, right, in this way. So the idea is lock down your lifestyle spending first, your core capital first. And that's probably, again, let's just call it what it is, maybe 3 to 5 mil net worth. Once you have that, lock it up, and everything else, all the gray stuff that should go to this, gets put in your irrevocable and put up in the cloud and gone away out of your estate. But you're not going to do that investing in like traditional investments or not being your own business owner, right? Some of you guys own businesses. You have the ability to get there. But if you're just working for the man making $300,000 a year or less, ain't going to happen. You need to take more risk. But for most of people in our community, that's not the need. We don't need private jets. That's one blueprint I'm showing here. But what's nice, once you have your core capital set, everything else is off the table litigators too when you're doing this. That's what's so nice. It's like so freeing in a way that you're set. You're in cruise control, that whole concept. I changed the terms a little bit to align, but it solves the question of like, all right, yeah, how much do you need and what's the concept? And then it's also the concept of what's the real goal. People who have read the book, the Bill Perkins book, Die with Zero. Yeah, that's a recommended book. It starts to talk about this idea of maximizing your experiences. So this is esoteric. So you have like money, right? We're all trying to get money, right? Money is very important when you don't have it. I think a lot of us, time is more valuable than money. In a strange way, you can change like money for time. Like I pay for the Whole Foods delivery thing. Whenever I get $40 worth of groceries, I have them delivered. I don't waste my time going to the grocery store, especially when you have young kids. I just pay. I don't care. Just pay. I'm paying for time. But there becomes a point where when you're older, you're sicker, and then you bring in health, right? You can't use money to pay for time at that point. But what is in the book, Die with Zero, the whole point is it's not necessarily time. Because you can have a lot of time and you can live an uneventful life, or experiences is the thing. And this is where I argue you need freaking money to exchange for experiences. And at the end of the day, experiences to me is the point system. Now you might disagree with me, but experiences is what I think is a score at the end of the day. Throughout this, we're all here playing this game, trying to get passive cash flow. But the real game is exchanging your money for experiences while you're optimizing your finances. That's the optimization question. Maximize experiences to optimize financing. Well, we all know that you're getting older and you could die at any moment, which is why you need a trust, and your core capital goes less and less. So it makes sense to like, all right, when I get older, I just need to trade these suckers in, this money in for experiences. This is in super fine print here. Most of you are trying to go, and this is myself too, are trying to go for 99% confidence that you will have enough to last and understand the trade-off for limited time to achieve that. What that means is we're scarcity minded. We're like squirrels putting nuts away in the tree, and we're just running around. We have a shit ton of nuts in the tree, more than enough for a winter in Hawaii. And this is like the case for the people in FUM, right? I think more times than not, they're still like working their asses off, even though their net worth is 3 to 7 million net worth, and just makes absolutely no sense. But that's the case. It makes sense, right? Because if you spent your whole life trying to save money, make money, you start to associate your sense of value on that. So that makes sense to me. But if you look at it like this diagram, it's stupid. But with that, thank you all for coming.
Going through this whole transition myself, it was really hard to do it without meeting other purely passive accredited investors out there. So that's why we've created the network, which you guys can join.